Hi folks, part 2 from chapter 9. Now we're going to take a look at some business expenses. So, business expense with personal benefits. What do you do? So first of all, if it's purely personal, then it's not a business expense. But one thing you can do is you can have what's called a mixed motive. The primary motive for some expenditures, has to do with business. And what you can do then is you can allocate. Now, how you allocate it depends. There's different ways. You can do it based upon the day, based upon mileage. There's a lot of different things. The main thing you got to remember is you got to keep records. Okay. So let's say you had to go to New York City for a conference, and the conference was 2 days, and you decided to go for 4 days, right? Stay a couple extra days. Those expenses related to those extra 2 days, okay? Those are definitely going to be personal, and they're going to give an example of this. Okay, so here's an example. Okay, Ben paid for the following to attend a business meeting in Chicago. He flew on an airplane, airfare. He was there for 3 nights, and meals for 3 days was $270. What amounts are deductible if Ben spent 2 days in meetings? And that would be the primarily business part. Okay. What amounts are deductible if the meals were provided at a restaurant? And what amount are deductible if Ben spent 1 day in a meeting? Okay. And then it's primarily personal. So it was primarily business because it was 2 days, and the last one was primarily personal. Okay. So here you go. If it was primarily business, okay, the airfare, it's all or none for that one. So there you go, $1,200. If it was personal, nothing. Okay. How about the hotel? $250 a day. He could take $500 if it was business, because he was there 2 days for business with meetings, and $250 personal. And for the meals, now we don't have to worry about the 50% limit because they were in a restaurant. So $90 here and $45 here. So were they provided in a restaurant? If they were provided in a restaurant. Well, if they were provided in a restaurant, you spent $270. If they were provided in a restaurant, this should be $180. Okay? Because would not be subject if they were provided by a restaurant. I don't know where else they would be provided. Okay. Anyway, there you go, folks. All right. What about business interest expense limitation? Okay. So the first thing does not apply if you make $30 million or less for the prior 3 taxable years. You don't have to worry about it. But the deduction is limited to business interest income plus 30% of the adjustable taxable income. So you have to calculate this part. Okay. So adjusted taxable income is taxable income allocatable to the business without regard for the following: no gains or losses, interest or income, depreciation, amortization, net operating loss deduction. Basically, it's they're looking at the core business activities is what they're looking at here. Okay. Kind of like business from operations. Okay. So here's an example. This year, MH reported $200,000 of taxable income on $30 million of revenue. The revenue included $20,000 of interest income. In calculating taxable income, MH deducted $240 for depreciation, $210 for interest. What is their maximum business interest deduction this year? Okay, so they're right at the $30,000 level. They deducted these items here. So what's the maximum they could do? Okay, so here's their taxable income, less the interest income, plus their interest expense, right? So when you add up all these, you're at $390,000 times 30% is $117, plus the interest income, $20,000. Maximum interest deduction is $137. Now I'm going to have to check on that because $30 million in revenue should be $30 million or less. Okay, so, and how much that interest expense of $210? I'm going to go check something. I'll be right back. All right, folks, I just wanted to go and check on that $30 million in revenue. Sounds to me like they're right on the cusp. So they calculated it as if they were a tad over the cusp. Otherwise, it wouldn't matter. Anyway, I just went to check, make sure they had it correct. Anyway, so there's the calculation. All right. So question number, chapter 9, question 3. The deduction for business interest cannot exceed what percent of the adjusted taxable income? Okay, what's the percent? Okay. All righty. Chapter 4. The limitation on the deduction, number 4, of business interest does not apply if a business qualifies as a small business with less than blank million under the gross receipts test. Okay. So what would it be under the gross receipt test? What number would that be? All right, next time we're going to take a look at sale of business assets. What happens when you sell business asset? So if there are losses, they are deductible, not to related parties. Again, remember, not an arm's length transaction. They're not going to let that happen. Okay. Now, casualty losses are limited to the lesser of the decline in value or the basis. So what they're going to take a look at here when it comes to casualty loss is the loss can't exceed what's left on the books for the basis or the cost to actually fix it. Okay. Then the basis is the amount of loss if the item's completely destroyed. Okay. So a little bit more, we're going to talk about, we want to learn to identify gross business income, or we've learned to identify deductible expenses. Now we need to match the income and the deductions. So there's 3 different methods. This one, hybrid, is only used for inventory. Okay. So basically you're talking about cash or you're talking about accrual. Okay. And again, some rules regarding that. So a little bit about accounting periods. Okay. The annual period, full tax year is 12 months long. Anything less is called a short tax year. Year ends, calendar year ends on 12/31. Fiscal year end depends upon the choice. Could be the last day of the month of any month, but not December. Okay. And this is the same day of a specific month. Okay. All right. Same days of a specific month. And the fiscal year, if you're choosing a fiscal year, it cannot be December. Okay. All right. So choosing the accounting period. How do you know how to choose it? Okay, so for proprietorships, it's the same as the proprietor's year end. And for individuals, that would be 12/31. C corporations and individual, the choice made on the first tax return is consistent with the book accounting period. So there has to be a consistent, and flow-through entities have a required tax year. And that has to match the owner's period. Okay, now for partnerships, this can be complicated because with multiple owners, who are you using? Okay, so, all right. So, regarding the methods of accounting. So, for financial and tax accounting methods, obviously for financial reporting, we use GAAP, okay? And generally, we're looking to accelerate income and deferred deductions. In contrast, for tax planning purposes, you're looking to defer income and accelerate deductions, okay? So, they kind of have basically what they're getting at here is first of all, they're 2 different sets of rules. And second of all, they look to move in 2 different ways, right? So, like it says here, reporting tax statement income, there are incentives to selecting methods that accelerate income and defer deductions, right? Shows higher income. Versus tax planning, which you want to defer income and accelerate the deductions. All right, folks, that's part 2 from chapter 9. Part 3 is coming right up.